Bonds aren't used to build wealth, but the best investors are the ones that preserve their wealth and lose the least amount of money. With a recession possible, especially after this highly suspect stock market manipulation propped up by the presidential election in 2024, bonds are starting to make a bit more sense within one's investing portfolio. By May 2025, it's projected that there's a probability of 51.82% that the United States will fall into another economic recession. This reflects a slight increase from the projection of the preceding month, but it's down from the January 2025 projection of a 61.47%. The US recession probabilities are predicted a year in advance by using the differences between the 10-year and 3-month Treasury rates. There's always talks of a possible recession coming, and who knows when this actually is going to happen. But no matter when or if it actually does happen, you need to know when it actually makes sense to be throwing some bonds into your portfolio. My name's Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So let's simplify the world of bonds. The old school way to build the 3-fund portfolio involved a portion going into US stocks, a portion going into international stocks, and then a portion meant for safety in something called bonds. In many other videos, I explain how this portfolio is very outdated and that one is missing out on so much profits by investing this way than in my new 3-fund portfolio, but this video isn't about that. I'll queue up that video at the end of this video and link to it down below, so check that out after this video. I also do and highly recommend private financial coaching and love to help people figure out the best strategy for them, since each investor should invest uniquely to their goals and situation. So email me at ProfessorG.invest@gmail.com to set up a consultation. Anyway, the one portion of that portfolio that's traditionally been allocated for bonds was using a strategy of diversification by making it so that your portfolio is invested, at least in some capacity, in something outside of the stock market. While the S&P 500 has returned an average of over 10% per year for the life of the fund, when we look at the actual returns each and every year, we can see that some years it's had negative returns, and even super big negative returns, like recently in 2022 with a negative 19.44%, and then really big years of positivity like 29.6% in 2013, and even up 18.75% right now in 2024. This is important because if you're near or in retirement age and you're not receiving a paycheck every single month, and you're living solely off of your 401k or investment accounts, that means that you're selling a portion of your account each year in order to have money to be able to live off of. Let's say you have a nice $1 million sitting in your retirement account, and it's in the S&P 500 alone. Each year you plan to take out 4% because historically that's been the number that most advisors would say is safe to take out in order to preserve your capital for your lifetime. So 4% of $1 million is $40,000, which is great because that's the number you need to live comfortably now that you don't have a mortgage. But let's say that the recession actually does come in 2025 and the market drops by 20%. Now your nest egg is at $800,000. You also still need that $40,000 to live off of, but $40,000 is not 4% of $800,000. It's 5%, which isn't great. And what if this recession lasts 2 or 3 years and each year it drops 5 to 10% more? Now your nest egg is sitting around $650,000 and you're depleting at 7 or 8% per year with no way to replenish these funds for the future since you don't have an income. So this is where bonds come in, and I'm going to explain exactly how to invest in them and which ones to consider. But first, let me thank and introduce the sponsor of this video, PolicyGenius. Since this video is all about safety and security, this is the perfect company for you to learn about for safety and security and something even more important, which is life insurance and protecting your loved ones. PolicyGenius is the country's leading online insurance marketplace. Saves you time and money so you can provide your family with a financial safety net starting today. Nearly half of American adults expect that if they died today, their loved ones would inherit their debt. We want to be a blessing to our loved ones when we pass, so PolicyGenius is a great option. Unfortunately, 41% of people don't have the life insurance coverage they need, and 40% of people with life insurance wish they had purchased their policies at a younger age. With PolicyGenius, you could find life insurance policies that start at just $292 per year for $1 million of coverage. Some options are 100% online and let you avoid unnecessary medical exams. Head to policygenius.com/investing-simplified or click the link down in my description right now to help you start saving today. So what is a bond and how to use bonds successfully to help set yourself up to be safe in a recession, but also to make sure that you actually earn more long-term in the stock market. Bonds tend to be less volatile than stocks and often perform better during recessions than other financial assets. However, they also come with their own set of risks, including default risk and interest rate risk. Think of a bond like a loan. It's a security issued by a corporation or government entity as a way of raising money. The investor lends the bond issuer a certain amount of money. The bond issuer then makes interest payments to the investor during the bond term and then repays the face value of the bond when it matures. Bonds come in many different forms that can generally be broken down into 3 categories. The first is corporate bonds. Corporate bonds are issued by public and private corporations. Interest rates on corporate bonds are affected by the creditworthiness of the issuing company, meaning a top-notch company may pay less. On the other hand, a high-yield bond, also known as a junk bond, may pay more. But because it's issued by a company with a lower credit rating, there's a higher risk it won't pay. Number 2 is municipal bonds. Municipal bonds are issued by states, cities, and counties and can be broken down further. The general obligation bonds, these bonds are unsecured debt government entities used for a variety of purposes. They're usually paid back with tax dollars the entities collect. Revenue bonds, these bonds can be used to finance particular projects and are typically paid back using the revenue generated by those projects. If the project doesn't generate the expected revenue, it could result in default. And conduit bonds, these are bonds that are issued by municipalities on behalf of private entities like hospitals or universities. In this case, the conduit borrower, meaning the organization on whose behalf the bonds were issued, must pay back the municipality. If it fails to do so, the municipality may not be able to repay the bonds. And the third category is Treasury securities. Treasury securities are issued on behalf of the U.S. Treasury Department. They're backed by the full faith and credit of the U.S. government, making them the safest of all bond types. Treasury securities fall into a few different categories depending on the term and nature of the bond. One example is the I bond, which pays a rate that's linked to inflation. With inflation raging in 2022, the I bond garnered much attention from investors seeking refuge from the flagging stock market. While the rate has decreased since then, 4.28% through October 2024 compared to 9.62% for a time in 2022, the I bond may still be a good long-term inflation hedge. A couple of good options for bonds are found on the U.S. Treasury website, treasurydirect.gov, but then also just an easier option might be a solid bond ETF, like BND, which does a lot of the work for you. There are pros and cons to both, but this is something that I want you to research a little bit further to see which option makes the most sense for your portfolio. As far as how to position them within your portfolio, that really has to do a lot with you individually. Each investor is unique and each situation that you're in is very unique, which is why I offer that private financial coaching and have been helping people to figure out where they actually stand. Because generally I can say how much bond somebody generally should have, but without knowing the full situation, it's hard to talk about what might be the best strategy. Generally, one would want to have more money set outside of the stock market, the closer to and within retirement. You'd want to make sure that your money's safe and sound if a market drop were to happen of 20 to 30%. So holding money in bonds is not the way that you're actually going to build wealth, but it is a way to keep yourself safe if worse comes to worse and the stock market crashes. If you're like 30 years old, you don't have as much need for having any type of bond within your portfolio at all, because you probably aren't living off of your investments and probably aren't going to be living off of your investments anytime soon. So you're okay to weather any type of dip or crash within the market and just keep investing. Your normal paycheck should be able to keep your day-to-day life totally okay. If you're closer to retirement or definitely in retirement, I believe you should have at least 3 years worth of your living expenses in something totally outside of the stock market. This could be things like bonds, but also CDs, the money market account, high yield savings account, just a regular savings account, something outside of the stock market, and even a combination of all of those. Most recessions only last a couple of months, but some of them can turn into something like a year or 2 years, and so by having those safe funds outside of the stock market, you can weather the storm, pull money from the safety net, and then just replenish that later on when we hit a bull market again. If you have to touch your investment money during a time when the stock market is down, that could be catastrophic for your retirement. To learn more about exactly what to invest in, and based off of that 3-fund portfolio that I was talking about earlier, and in exactly what percentage based off of your age, which is the missing key, watch this video now or watch this one to keep you going strong in your investing journey.